Too many property investors are focusing on the wrong thing, and it could be costing them six figures. This thing is year one return on investment, or more specifically, rental profit. If you're new here, my name's James, and this channel is all about helping you build and grow your knowledge about property investing without gimmicks or unrealistic promises. I'm the co-founder and managing director of a property investment business called Freighter Property Partners, but this channel is all about helping you. If you like the content, don't forget to hit like and subscribe to the channel for all things property investment. If you're not new here, welcome back and let's get started. So your ROI, or your rental profit, is the return on the cash that you've put into the property in total. So for example, if you buy a property worth 200 grand, you put 50 grand in as a deposit, you pay for things like stamp duty, legal costs and broker fees. Altogether, you would have put 70 grand or so into the property. Your return on investment, or your year one ROI, is the return on that £70,000 you've invested. I completely understand why property investors use this and things like yield to look at their return on investment, but it doesn't paint the whole picture. And if year one return on investment is the only thing you're looking at when reviewing deals, the chances are you're going to buy the wrong thing. You're going to buy cheap properties that yield well but won't have long-term prospects, and you're not going to get any appreciation on the assets that you're purchasing. As you would have heard me speak about in previous videos, property investment is all about the long-term prospects and the long-term growth of the assets we own. We build our wealth through leverage and buying properties in the right locations that will grow in value over a number of years. This gives us the opportunity to build our portfolio in the long term, recycle our equity through refinances, and get to our long-term goals without having to save cash every single year to invest. The reason we're looking at this is because I speak to property investors all day, every day, and you'd be surprised how often I speak to people and they're only looking at their return on cash. So lots of them look at 8% return on cash, 12% return on cash, but it's not the whole picture. If you're just focused on your year one return on your investment, the chances are you should probably invest in something away from property. You're more likely to get better short-term results in things like stocks and shares and other investments than you will within property investment, but when you hold property for the long term, you allow property to do its thing and grow in value, you leverage that investment, that's where you're going to come into your own. Especially because these properties that have the best return on cash in year one are often cheap properties that don't grow in value. We should be looking at properties that improve over time, so your investment works harder and harder for you as the years go on. With these types of properties, that doesn't happen. You'll get a year one 10% return on cash, but that rent might increase in line with inflation, and that's about it. If the property doesn't grow in value, your investment is actually getting worse year on year because of inflation. If that property only grows by 10% in a 10-year period, and inflation's been at 2% in that time, then you've actually lost 10% because of the lack of appreciation of the asset. If you compare that to buying a property where you're only getting a 4% return on cash in year one, but it grows by 4 or 5% a year every single year for 5 years, and you've leveraged that, obviously that is a way better return on investment. So let's look at an example. Tony buys a property outright with an ROI in year one of 9%. That means he'll get £9,000 return on 100k that he has available. Hannah, on the other hand, buys a property worth £300,000 that she's leveraged. So she's put 75 grand deposit down, she's paid for things like stamp duty, legal costs and broker fees. Although Hannah's only getting a 4% rental profit, or year one ROI, she has great prospects for long-term growth. After the first year of them owning the properties, Tony's property's not grown in any value, but Hannah's has grown by 5%. So if we look at the true ROI on those investments, Hannah will have seen 15 grand worth of growth and £4,000 of rental profit. That's a total of £19,000, which is a 90% return on investment. Tony, on the other hand, because he's not seen any growth, he's only getting the 9% rental profit, and that's it. That's where other investments probably can outperform property. Tony obviously could have leveraged his investments, and rather than buying one worth 90 grand outright, he could have bought multiple properties and leveraged them, but it doesn't really matter. If you're not getting any growth, your ROI isn't going to get any better, and essentially that's the best you can get. And this is just after 1 year. If Hannah has targeted a location that's going to grow in value year on year on year, she's made sure the place that she's buying has all of the fundamentals to improve, this ROI should continue, and the chances are she'll have all of her money back in just a 5-year period. The reason a lot of property investors miss this is because it's difficult to know what your ROI is going to be in 1 year or in 5 years because of capital growth. You'll obviously be able to work this out backwards once you've owned the property for 5 years or so, because you'll know how much the property's grown by and what your true ROI is. But the best way for you as an investor to do that now is look at forecasts, make sure that you're following the fundamentals, and give yourself the best opportunity to get the best return on investment you can do. So that's both rental profit and the appreciation of the asset during the time that you've owned it. And like always, leverage when you can, when you're growing, because it will maximize your returns. This isn't me saying rental profit or year one ROI isn't important. You need to be making a return on your investment. You don't want to just break even in year one. You want to make a little bit on top to give yourself some wiggle room if you ever have to pay for anything. But it's not the whole picture. And if you're an investor that's only looking for rental profit, unless you're at a point where you already have a portfolio that's growing in value and giving yourself that appreciation over time, the chances are you may be doing things a little bit wrong. So how do you as an investor not fall into these traps? First is think long term. A 5 to 10 year perspective will give you the opportunity to build your wealth through property as long as you focus on the fundamentals. And the second is just that. Focus on strong fundamentals and not cheap properties that will give you quick ROI. And the third is know your numbers, but more importantly, know your goals. Make sure all of your decisions go towards that end goal so you can be confident on achieving that in the long term. So hopefully this video has helped you understand why you need to look at the whole picture of return on investment, not just your year one rental profit. You now know the traps to avoid and what to look for with an investment. But that is it for today's video. So thanks again for watching, and I'll see you in the next one.